How's it going, friends and family? My name is Amos, and the reason why software stocks are getting crushed, it's not because of their financials and fundamentals today. Because if you pause and just look up any one of these companies right now, rock solid fundamentals, metrics, the software rule of 40, PEG ratio, whatever it is, looks really good. It's because of the potential future. The markets are forward looking, and Wall Street, hedge funds, big investors, retail investors, everyone's kind of scared about what's to come. Because up until the vibe coding threat, software businesses, they used to make a killing by charging for per person in a seat for an enterprise license or a contract agreement. But we're learning that not every person is needed in a seat anymore, like in the past, because agentic AI is changing the name of the game. That means, as a general rule of nipple, software stocks will make less money per enterprise customer. For instance, Adobe having a contract with Procter & Gamble or Nike or the Campbell Soup Company. In the past, if they used to charge them $15,000 because there was 25 people in their creative social media team, but now that number is getting reduced down to 5 members, they can't charge $15,000 anymore. Does that make sense? Changing gears a bit, that's where I want to pump the brakes. This really reminds me of 5 years ago in 2020, 2021, when energy and oil and gas stocks, they got absolutely shattered and destroyed because of the green wave, renewables, and EVs. We thought the oil industry was going to disappear overnight. As if that can happen, right? You take a look at their CAGR and performance, they're now pushing new all-time high valuations because as we realized, replacing oil and gas, it takes time. And it's not going to happen in 24 hours or in the next 1 to 2 years. No, oil and gas, they're here to stay. And that's what this situation reminds me of the software sell-off. So overblown, so emotional. But to stop myself, yes, I think software stocks, they are going to take a hit on their numbers. But the narrative that AI is going to replace every single person in a seat or replace the software in question, dude, it ignores the reality of integration, accountability, and ongoing support. That's why you pay for the software stocks. You can't just trust willy-nilly 100% into something that was vibe coded. Because if it goes wrong, who's going to be held accountable? All that to say, between you and me, I've been buying into the software sell-off. Not all of them, but only into specific companies. So in today's video, I'm going to be sharing with you my framework that I created to rank every software stock out there by their resilience and business model sustainability going forward. Because, as I just alluded to, not all of them are opportunities in my opinion. I think it's a sinking ship or catching a falling knife. Now, if you want a more thorough breakdown of the tiers that you're about to see, did you know there's a part 1 to this? All right, let's get into it. I'm going to be completely honest with you. I created this tier system with inspiration from Jensen Huang's 5 layers of AI. So starting at the bottom, tier 1, I have this labeled as the foundational infrastructure of everything in the software stocks landscape, right? All of this exists because of the tier 1 cloud, the data centers, and storage. So to me, I think there's only 4 players in this category. I mean, I could be missing one. Maybe an argument can be made for NVIDIA. But for the time being, it's Microsoft, Google, Amazon, and Oracle. That one, even just rolling off the tongue, it's a little icky, but I think Oracle is tier 1 for the data centers that they're building for OpenAI. Now, for other people, just hearing that, you might be bearish, especially with their debt levels, which makes sense. But anyways, these 4 businesses to me are tier 1 because I think they're the most resilient in the face of vibe coding and competition sprouting up because it takes over $150 to $200 billion of CapEx a year to just fight them. So I think they're cemented, their economic moats are vast, wide, and their business models are robust. Now moving on to tier 2, instead of calling it workflow platform like I did in part 1, I think it's better described as enterprise backbone. So whatever they're doing is so freaking important for the operational requirement for the whole company to run. Not just one department, not just for one team. Or the second category in tier 2, if they're in the business of proprietary data, with having a regulatory moat that the law requires you to use, or a private database that vibe coding cannot replicate or access. So I have names such as SAP and their enterprise resource planning. It allows every department to be on the same page. One centralized system. It runs the payroll, accounting, inventory, supply chain, procurement, most definitely a central nervous system type of business. Also, I would argue ServiceNow. And then there's also Palo Alto Networks, ticker symbol PANW, and this one's a cybersecurity operation, but their defense is a platform that's across the cloud, network, and endpoint security. So if you pull the plug on Palo Alto, the company's entire ability to safely exist on the internet, it stops instantly. So that to me is tier 2. And also in the cybersecurity space, we have Fortinet, and their most relevant offering is the FortiOS. And it's a unified nervous system that runs everything from the office Wi-Fi to the industrial firewalls. It's the end-to-end backbone for any company that has a physical presence, such as retail stores, factories, office buildings. I think they're tier 2. And then there's also CrowdStrike, ticker symbol CRWD. It's an all-or-nothing backbone from my understanding. If you pull the plug on CrowdStrike, the Falcon agent that sits on every single laptop of every employee and server in the company is immediately blind and they become defenseless. And then changing gears a bit, we also have Snowflake, ticker symbol SNOW. This is the data backbone, or I guess the digital brain of an organization. It keeps track of all the data across customer logs to even sales data. And not too long ago, they just transitioned from charging per seat to now charging for work done, or the amount of data that's processed, and it's been working out well for them. And also in tier 2, we have Salesforce, ticker symbol CRM, the biggest customer relationship management software provider. Listen, this one I know people are going to push back on, as I elaborated in part 1, but they're definitely a central nervous system for a company's customer data that supports multiple teams. It's not just one department: sales, marketing, HR, talent acquisition, and finance, and more. And traditionally, Salesforce, like other SaaS players, they used to sell per seat, but now they're selling per conversation that's handled by Agentforce. So I think it's like $2 per result that's driven by Agentforce. So even if a company pays for less butts and seats, theoretically and on paper, they'll end up paying more because that one seat will accomplish more, because Agentforce can do the work of at least 5 junior employees that used to cost the company $80,000 total compensation per person. So don't you think that Salesforce is going to charge for that result? Maybe not all $80,000 per individual, but a good fraction of it, okay? And then jump into the other side of tier 2, the proprietary data. First one I have is Hamilton Lane. They have 30 years of private equity and venture capital data that no one else has, and they're in the business of private wealth management. This is a company that I shared for the Patreon family that's on my radar and on my watch list. And then we also have VRisk, ticker symbol VRSK, and they own the pool of data that insurance companies use to determine underwriting and to calculate risk. They have buy-in from over 100 insurance companies who share their data with one another so that they can each mutually benefit from it. Also, another company that I shared with the Patreon family, and then another proprietary data player, is CoStar Group, ticker symbol CSGP, and they own the world's largest database of real estate information, like the building and physical specs, the contact information for the actual landlords, and more. And then for the next group of 5, they own the stock market index or bond and credit ratings. Their stamp of approval or title, they get kickbacks and royalty fees for it. So when we talk about Moody's, NASDAQ, MSCI, S&P Global, FICO. And before we jump into tier 3, I would really appreciate it if you guys could click like on this video, because this is a project that I've been working on for the past 2 weeks now, and I'm sharing it for free instead of putting it exclusively for the Patreon community. So if you could just do me that solid, it would mean a lot. Now, moving on to tier 3, I have this labeled as the vertical, fully integrated software, a one-stop shop from point A to point Z, all in one platform for one specific niche. Not for everyone. You prioritize one section of the market. So the first one is Veeva Systems, ticker symbol VEEV, and they manage the entire life cycle for a drug pipeline, including the clinical trial data, doctor relationships, and marketing compliance. Because believe it or not, the marketing team for a pharmaceutical company, there's a lot of strict guidelines. Believe me, I used to be on the strategy team for one of the biggest pharmaceutical companies in the world. I know from firsthand experience. And then number 2, we have Procore. And in the construction space, it connects the office to the field. It makes everyone aligned with what's going on, the project management. It handles the blueprints, safety logs, the RFIs, the requests for information, and financial tracking. And then we also have Service Titan, and it caters to the HVAC, plumbing, landscaping, pest management crowd. It manages the technician's entire day, dispatching, GPS tracking, on-site estimates, financing for the homeowner, and marketing to get new leads. Service Titan, I like, but their financials are just kind of icky to me. And then we also have Shopify, a Canadian business, believe it or not, and it provides the end-to-end infrastructure for the merchant. So they own everything from the storefront to inventory to payment processing and even shipping. It's fully vertically integrated for an online business. And then there's also Toast. In the restaurant space, they're best in class and they have the biggest market share. They do everything, including payroll, reservations, inventory, the digital menu, and even loans. And then there's Roper Technologies, and they make software for multiple industries such as the trucking and supply chain field, hospital systems, school administration platforms, water meter systems for the utilities, and law firms. And last but not least, in tier 3, fully integrated, is Tyler Technologies, and they cater specifically to the public sector. Nearly all of the software and platforms that the local and state governments use, it's owned by Tyler, including the DMV, the courthouse, or even the city's tax department. And then tier 4, all the way up at the top. These companies I have labeled as horizontal tools. And that's because these companies cast a wide net, right, horizontally for everybody. They don't just prioritize one industry. Now, what I'm about to say next, I already know that I'm going to ruffle up some feathers, and that's because a lot of retail investors and YouTubers, everyone seems to be bullish on Adobe. People keep saying that Adobe is a backbone enterprise. They're tier 2, tier 3, tier 1 because everyone uses it. Dude, that's like saying a hammer is a backbone of a house because every carpenter uses one. No, it's not. Adobe's not a whole company nervous system. They sell a horizontal creative toolkit that any industry can use. And I just uploaded a 30-minute bare thesis on Adobe, so I'll leave it at that. And then there's also Adobe's competition, Figma, that specifically sells a digital drawing board that's really collaborative based for the creative team. And also in tier 4, we have UiPath with their RPA bots that automate tasks that are on top of other software. It's not fully integrated. And then there's also Autodesk. They have really important software for engineering, manufacturing, the supply chain space, and architects that help to design buildings and bridges. But if Autodesk goes down, the HR team can still hire. The sales team can still pitch whatever it is they're trying to sell, and the finance team can still send bills. So it's not tier 2 and it's not tier 3. And then there's Constellation Software, another Canadian company. This one right here, I had a lot of trouble with because they own thousands of independent small software companies under them. The best way to describe them is they're kind of like a software landlord. And after taking a look at them, I think, I could be wrong, but I think a lot of the software that they own in their portfolio, they're going to be losing customers left and right from vibe coding. However, based on my research, I think they're doubling down and saying that the service and support that they provide to, I don't know, like one of their softwares is for the funeral homes, right? Or to a water utility company in Canada. It's value add against the vibe coded software because they can help you if something goes wrong. But I do think with Constellation, an argument could be made for them to be in tier 2 with the massive amount of data that they own in their record log. But the reason why I have them categorized in tier 4 is because a majority of the software that they sell is tier 4. I think they do have some tier 3 caliber type of software as well. And then in tier 4, we also have Okta cybersecurity, which basically allows an employee of a company to log in. And then there's also Zscaler. It's a cloud tunnel tool type of cybersecurity. It doesn't provide an end-to-end solution, right? Like some of the other ones that we talked about in tier 2. It just secures the connections to all of the various apps within an enterprise. And then there's also Rubrik. This one is really interesting in the cybersecurity space. They're not trying to defend you. They're already insinuating that one day you're going to get hacked. So they're in the business of securing your data so that when it gets hacked, you can recover it and that the hackers steal irrelevant information. Does that make sense? Now, even though Rubrik is in tier 4, I like this one. I actually feel really bullish about them. And then another cybersecurity stock is SentinelOne. And they specifically make cybersecurity for making sure that laptops that belong to an organization are secure. And I absolutely think that's important, but I don't see how they're any different from the competition from like Cisco or whatnot, okay? And then there's also Intuit. I think they're the textbook definition of what tier 4 is. It doesn't mean that it's bad just because they're horizontal, okay? Because when you think about it, Intuit's products and offerings like TurboTax, QuickBooks, and whatnot, they have built an ecosystem, a financial toll road that almost every single small business in America drives on and pays that fee. However, vibe coding software, at the time of making this video, they're attacking the legal, finance, and payroll players directly. They're able to replicate and create software that can do all of your taxes on the spot. And that's why Intuit's been really suffering. However, from my research, Intuit's not just sitting on the sidelines and saying, what should we do? They're actively partnering with OpenAI in a $100 million deal to help bake in AI agents into their software to automate most of the tax and payroll process. So if you're a customer of an Intuit product, you don't really have a compelling reason to jump ship if they're gonna make your life that much easier. So even though Intuit's in tier 4, I like Intuit. At its current price, no, I think there's more room to fall, and then I might open up to the idea of buying into them. And then also in tier 4, I'm not going to explain too much, but it's where DocuSign, Atlassian, Asana, Zoom, Zendesk, Monday.com, Dropbox, Duolingo, Freshworks, Five9, Nice, that's where they all belong. Now here's my closing statement on tier 4. They're the ones that I just genuinely feel uncertain about as we're trying to navigate and learn the power of vibe coding software. I think some of these tier 4 players, I think they're going to crush for decades to come, right? I think they'll continue to be a compounder, no doubt in my mind. On the other hand, I think a majority of them are going to disappear because of AI. I would argue it's the Hunger Games here, survival of the fittest. With tier 4, like your odds of picking the winner, it's slim. Whereas with like tier 1, if your timeline or horizon is long-term, 5 to 10 years out, it's kind of hard to miss, right? And then the probability for tier 2 goes down ever so slightly. And then for tier 3, it goes down significantly. And for tier 4, it's so difficult to the point where I just don't feel comfortable. Honestly, I think the software stocks can just transition from a pay-per-seat business model to a pay-per-outcome or results-based model and still thrive. I'm putting my money where my mouth is, and I've been buying into a software, conglomerate company day after day, dollar cost averaging to the point where I'm hoping it can become the biggest holding in my public portfolio. Then again, on the other side of the argument, the entire business software in question, it can be replaced by a vibe-coded competitor. So I guess only time will tell who's going to survive, who's going to thrive. Now, before we wrap up, I want to share something with you. I'm going to tell you right now, I'm going to double down. I'm going to keep leaning into long-form content like this. Videos that feel more like a conversation, like you and I in a basement, butt naked, just chilling, or kind of like a podcast. Deep dives and just slower breakdowns. Dude, that's what I genuinely like to do. I don't want to change who I am in order to be someone that I'm not. Because with my style, we really take the time to understand what we're talking about. And that's how I think. That's how I invest. I enjoy sitting with the numbers, the risks, the story, and thinking out loud the investing thesis. Yes, there's other creators out there that just punch, bam, done, and everyone is following suit. The internet moves fast, and I know fast-paced content does well. They succeed, but that's not me. So I understand that by choosing this route, I'm literally making a public declaration. Yeah, we're going to see slower subscriber growth, and it's not going to make the algorithm happy, and I'm going to be okay with that. I don't want to change the content because after taking some time to think about it and reflect, I care more about building a community of people who value depth, patience, and long-term thinking. People who want to compound knowledge the same way that they compound capital. If you buy into the idea of dividend compounders with cheese, I think there's people that just very impatient, just want everything up front, 30 to 60 seconds in a breakdown. And I'm like, dude, that's just not enough time. And I don't want to judge or make generalizations, but the same crowd of folks that are looking for get rich quick overnight type of ideas and volatility, and I just don't have that risk profile. I basically have the soul and the heart of like a 61-year-old, okay? I look young, but the way that I think and the way that I operate, very conservative because I grew up in a lot of poverty. And so with my finite amount of capital, I don't want to lose it. I would rather go with the slow and steady and compound surely over time than the gamble and the risk of getting 3 or 5xing my money or losing everything, nothing in between. That doesn't really excite me. So if you're still here watching these longer videos, dude, I appreciate you so much. This channel is built for you. For me, literally content that I myself would want to consume while washing the dishes or on my work commute or while I'm at the office, put a little Apple AirPod in and listen to. Like, this is the kind of stuff that I would listen to. And you might be like, where is this coming from? Why are you saying this? It's because in light of the past 2 weeks, I've been getting more and more negative comments from people who don't know who I am. They're being exposed to the channel for the first time, and they say some hurtful and negative stuff. And it's a really good lesson, not only for me, but for you as well. You can't please everyone in life. If you know your core audience, your stakeholder analysis says this is the demographic, then that crowd is who you should double down and focus on and prioritize. If you try to win everybody, then you become a tier 4 horizontal tool. Right? Having said that, I appreciate you guys. Stay safe. Good luck in the stock market. And I love you in case no one has told you recently. Okay? Peace.